You are now a merchant in ancient China, roughly 3,000 years ago. You have spent everything you own, every coin, every asset, every resource your family has, on a shipment of goods that you are about to send down one of the most dangerous river trade routes in the known world. Rapids, rocks, pirates, storms, any one of these things could appear at any moment and swallow your entire shipment whole, leaving you with nothing, leaving your family with nothing. One bad day on that river and your entire life's work disappears beneath the water. So what do? You do something so brilliantly simple and so deeply human that it will echo forward through 3,000 years of civilization and land directly inside the monthly debit order, leaving your bank account right now. You take your goods and you split them across multiple boats, not because it is more convenient, not because one boat cannot carry them all, but because if one boat sinks, only a portion of your goods goes down with it. The other boats survive. You lose something, but you do not lose everything. You have just invented the foundational principle of insurance. Risk spread across multiple points so that no single disaster can destroy you completely. Ancient Chinese river merchants were practicing risk pooling 3,000 years ago without a single piece of paper, without a single signed contract, without a single company logo or policy number. They did it through pure survival instinct. And that same instinct, the deep human need to protect against catastrophic loss, is what every insurance product you pay for today is still built around. Now move forward to ancient Babylon, around 1,750 years before the birth of Christ. King Hammurabi, one of the most famous rulers in all of ancient history, has just finished writing one of the earliest legal codes ever recorded. You have probably heard of the Code of Hammurabi. Most people know it for the phrase "an eye for an eye." But what almost nobody teaches you is that buried inside that same ancient law code is something that historians recognize as the world's first written insurance contract. The Code of Hammurabi contains specific provisions for merchants taking out loans to fund sea trading voyages. The agreement worked like this: a merchant borrowed money to buy goods for a voyage. If the ship arrived safely and the goods sold, the merchant repaid the loan plus significant interest. But if the ship was lost at sea, if a storm sank it, if pirates took it, if disaster struck, the merchant owed nothing. The loan was completely cancelled. The lender absorbed the loss entirely. Think about what that actually is. A merchant pays a higher cost, higher interest, in exchange for protection against catastrophic loss. The lender takes on the risk of total disaster in exchange for a higher return when things go well. That is not just ancient commerce. That is the exact structure of every insurance policy you have ever signed. You pay a premium. The insurer takes on the risk of disaster. If disaster strikes, they cover the loss. If it does not, they keep your premium and profit from it. Hammurabi's lawyers figured out the insurance model in 1750 BC on clay tablets in cuneiform script, and the fundamental structure has not changed once since then. Now, here is where the story takes a turn that will genuinely surprise you. Ancient Rome, the civilization that gave the world roads, aqueducts, legal systems, and military strategy, also gave the world the first recognizable life insurance product. And it came from the most unexpected place imaginable. It came from funeral clubs. In ancient Rome, ordinary working people, soldiers, craftsmen, laborers, merchants, joined what were called collegia. These were organized groups where every member paid a small regular contribution into a shared fund, not for investment, not for profit, for one very specific purpose. When a member died, the fund covered the cost of their funeral and provided financial support to their surviving family. Members paid in during their healthy years so that when death arrived, suddenly, as it always does, their family would not be left with nothing, and their body would receive a proper burial rather than be left in the street. This was the world's first life insurance system: monthly premiums, a shared pool of money, a guaranteed payout when the covered event occurred. Run not by corporations but by communities of ordinary people protecting each other from the financial devastation of death. The Roman government eventually regulated these clubs, recognized their social value, and allowed them to operate legally across the empire. And then, fast forward to 1666, London burns. The Great Fire of London destroys over 13,000 homes across the city in 4 days. Families lose everything overnight. And out of that catastrophe, out of that citywide devastation, something new is born. The first modern fire insurance company. Nicholas Barbon, a physician turned property developer, begins offering fire insurance contracts to London homeowners. Pay a regular premium, and if your house burns down, the company will rebuild it. Within a few years, other fire insurance companies follow. London fire brigades, the first organized firefighting teams in the city, were not run by the government. They were run by insurance companies who sent them specifically to save buildings belonging to their paying policyholders. If your house was on fire and you were not insured with that particular company, their firefighters would watch it burn. And finally, before we bring you all the way to the present, here's a story that most people find completely impossible to believe, even though it is entirely true. The global insurance industry, one of the largest and most profitable industries on the entire planet, was born inside a coffee shop. In 1688, a man named Edward Lloyd opened a coffee house on Tower Street in London. It became a gathering place for ship owners, merchants, and sea captains who needed to share information about their voyages. And gradually, wealthy individuals who wanted to profit from maritime trade began visiting Lloyd's coffee house to offer financial protection to ship owners heading out on risky voyages. For a fee, a premium, these individuals would write their name and the amount they were willing to cover at the bottom of a ship's risk document. They were called underwriters because they wrote their names under the risk. Lloyd's of London, today one of the most powerful insurance institutions in the entire world, insuring everything from celebrity body parts to satellites in space, started as men drinking coffee and writing their names on pieces of paper in a room above a London street. You are back in the present, and somewhere in your monthly expenses, possibly without even thinking much about it, you are paying for car insurance, health insurance, life insurance, renter's insurance, or some combination of all of them. You pay the premium. The month passes, nothing bad happens. You pay again, month after month, year after year. And most people, if they are honest, have a quiet voice somewhere in the back of their mind that asks the same uncomfortable question every time the debit goes off. Am I paying for something I'm never actually going to use? That question is the insurance industry's greatest business model, and understanding what sits behind it will completely change how you think about every policy you hold. Here's the truth about how insurance companies actually make money, and it is not what most people assume. The obvious answer is premiums. You pay in, you never claim, they keep the money, and yes, that is part of it. But the real engine behind the profitability of the world's largest insurance companies is something called the float. When you pay your insurance premium, that money does not sit in a vault waiting for you to have an accident. It goes straight into investments, stocks, bonds, real estate, government securities. The insurance company collects hundreds of millions of dollars in premiums every single month and immediately puts all of it to work earning investment returns while they wait to see whether any claims arrive that they actually need to pay out. Warren Buffett, one of the wealthiest investors in human history, built a significant portion of his fortune specifically on this concept. His company Berkshire Hathaway owns major insurance businesses, not primarily because insurance premiums are profitable, but because insurance gives him access to enormous amounts of other people's money to invest before any claims are due. He called it having access to free money. The insurance industry understood this centuries before Buffett was born. You are not just paying for protection when you pay your premium. You're handing a pool of capital to a company that will use it to grow its own wealth while your coverage sits waiting. Now here's the myth I want to completely destroy for you right now, because it costs ordinary people real money every single year. Most people believe that making an insurance claim is always the right move whenever something covered happens. Something breaks, something gets damaged, something goes wrong, claim it. That is what insurance is for. But here's what the industry knows and does not rush to advertise. Every claim you make gets recorded. That record follows you. And in most cases, making a small claim raises your premium at renewal by more than the claim was actually worth. If your car takes minor damage worth $400 to repair and you claim it, your premium could rise by $200 a year for the next 3 years. You claimed $400 and lost $600. The claim cost you $200 net. You would have been financially better off paying the $400 out of your own pocket and keeping your record clean. The ancient Roman funeral club member understood something instinctively that modern policyholders forget completely. The club was for catastrophic loss, for the moment that genuinely destroyed everything and left a family with nothing. It was not for small inconveniences, not for minor repairs, not for situations a person could absorb financially without serious damage. The club was the last line of defense against complete devastation, and that is exactly how you should treat your modern insurance policies. Your insurance is not a maintenance plan. It is not a repair fund. It is protection against the event so large, so sudden, and so financially devastating that you could not possibly recover from it alone. Use it for that, only for that, and for everything below that threshold. Build your own emergency fund, a private pool of money sitting in a high-yield savings account, so that minor disasters come out of your own resources rather than your claims record. The Babylonian merchant paid higher interest to protect against total loss at sea. He did not expect his lender to cover the cost of a torn sail or a slow trading day. He reserved the protection for the catastrophic. You should do exactly the same. 5,000 years ago, a Chinese merchant split his goods across multiple boats because he understood that no single disaster should be allowed to destroy everything. 3,000 years later, a group of men in a London coffee shop turned that same instinct into a global industry worth trillions of dollars. And today that industry is collecting your premium, investing your money, and profiting from the float while you hope that nothing bad enough to claim ever actually happens. Insurance is not your enemy. Used correctly, it is one of the most powerful financial protection tools you will ever have access to. But used blindly, claimed on small losses, misunderstood, overpaid for coverage you do not need, it becomes one of the most consistent and invisible drains on your monthly income. The merchants of ancient Babylon knew exactly what they were paying for and exactly when to invoke the protection. Now so do you. Subscribe to Money Through the Ages, because next time we are going even deeper into a financial word that controls more of your daily life than any other, and the ancient story behind it will leave you genuinely speechless.